Hello and welcome to The Chart Show. I'm Victoria Scholar, and each week I'll be sharing my analysis on three key stories that are getting a lot of attention among investors. I'll be breaking them down, not just from a fundamental perspective, but with technical analysis on the charts as well. This week's three charts are Zoom, which slumped amid concerns about its growth outlook, AO World, which saw its shares plummet after its second profit warning in 2 months, and British Airways' parent company IAG, which is upbeat about transatlantic travel. Shares in Zoom slumped by more than 16% on Tuesday, despite reporting quarterly results which beat on the top and bottom lines. Investors were concerned about its growth trajectory, however, with revenue falling from above 300% in the January quarter to 54% in the summer and now down to 35% in the latest figures, raising concerns about its ability to maintain strong growth post-pandemic. Last year, the stock enjoyed a massive rally of more than 400% as the poster child stock of the pandemic, with its share price performance closely correlated with lockdowns, travel restrictions and COVID cases. Zoom has been trying to diversify away from video and audio communications by attempting to acquire cloud contact software firm Five9 for $14.7 billion. However, the deal unfortunately fell through in September. Let's take a look at the chart now of Zoom, because since the peak in October of last year, the stock is down by more than 65%, with losses accelerating lately. It's down 50% since the peak in August and has struggled with a string of consecutive red candles on the chart last week and this week. The stock has broken below key support term resistance at the 61.8% Fibonacci retracement level near $260. The results also pushed the stock below psychological round number support at $200 a share. On the one hand, the stock is sharply above its IPO price of $36 a share from 2019, but on the flip side, shares are just over a third of their value at the peak, around $590 a share. A descending trend line is in play, with the next significant hurdle at 172. That's the 78.6% fib level. AO World fell the most in over 6 years, with shares down by more than 25% at one stage on Tuesday. The electricals retailer downgraded its outlook for the rest of the year, with driver shortages and supply chain issues weighing on the business. This is the second profit warning for the business in 2 months, with the white goods retailer now warning of shortages during the all-important festive season. AO World is just the latest among a series of retailers, including IKEA, which warned about issues with the supply chain and the labour market. Let's check in on the shares of AO World, because the stock closed down by almost 17% on Tuesday. The stock is down nearly 70% so far this year, with a more than 20% slump since the start of October, driven by its 2 profit warnings. The stock has been trading in a descending trend line for most of this year, with lower lows and lower highs pushing below the 78.6% fib level. If the downtrend continues, it looks as though the stock could ultimately retrace 100% of its sharp gains that it enjoyed last year during the pandemic. A move down to 46.80 would represent a full reversal of last year's gains. However, the stock is still a significant way above that scenario, and it needs to break below near-term support at the round number of 100 first. If it can manage to hold above 100, however, that would act as a slightly more positive indication for the shares. Shares in IAG, the parent company of British Airways, gained on Monday and Tuesday after the company's CEO, Luis Gallego, said that transatlantic bookings are now nearly at 100% of 2019 levels before the pandemic. He thinks North Atlantic routes will get back up to full capacity by next summer. However, there's been a lot of uncertainty around the outlook for the travel sector, particularly in Europe, with Austria re-entering a COVID lockdown, with stocks in the sector weighing on the FTSE 100 last week. In fact, £2 billion were raised from UK airlines and travel companies last Friday after Austria's decision was announced. Shares in BA's parent company are trying to recover from 2-month lows hit last week amid the increased travel restrictions. Checking in on the shares, this year the stock started on a positive note, gaining more than 50% in the first 2.5 months. However, since the March peak, a shallow descending trend line has emerged with a series of lower lows and lower highs, although more recently there have been some technical signs that the downtrend could be starting to wane. Firstly, after the September low, the stock failed to log a fresh low and instead logged a higher low. Recently, we also saw the RSI indicator come close to oversold territory, although it technically avoided going below the threshold of 30. In order to believe that the downtrend remains intact, look for a break below the September low at 136.80 as confirmation. A push below could point to further declines.